Good afternoon and welcome to the Sheriff's Office Retirement Plan Board meeting held on Thursday, October 28th at 1 o'clock in the afternoon. We are in the Chesapeake Building at Baldridge Street in Leonardtown. Public meetings are open to the public. In lieu of in-person attendance, citizens may listen to the meeting by calling 301-579-7236, access code 963443, pound, or view the meeting remotely on Channel 95 and YouTube. For today's meeting, we'll open with a call to order. We are all present. I'm Rebecca Bridget, the County Administrator. To my left is Jeanette Cudmore, Chief Finance Officer, and John Walters, our Citizen Member. To my right is Catherine Pratson, our Plan Administrator, and joining us on Zoom is Lieutenant Sean Moses with the Sheriff's Office and Lieutenant Clay Safford with the Sheriff's Office. Thank you, gentlemen, for joining us.
Good afternoon.
And thank you to our staff. Supporting the committee today is Sheila Smith, Plan Coordinator, and Amy Carter, our videographer. So with that, we'll move to item 2 for the roll call. If you'll take a minute to look at today's meeting agenda, then I'll request approval of the meeting via motion, please.
Move to approve.
We have a motion to approve the meeting today, the meeting agenda today. Is there a second?
Second.
Any discussion? Hearing none. All in favor?
Aye.
Aye.
And Lieutenant Moses, you're on mute. If you have a chance to unmute and give us a vote, that'd be great. Great. And it looks like he's not muted now, Sheila. Is that correct? Mm-hmm. Okay, great. So we'll move on. Oh, I'm sorry. I heard everyone vote except for Lieutenant Moses, so the motion carries. Any opposed? Thank you. Motion carries. 2B is the approval of the September 23rd, 2021 meeting minutes. If you take a minute to review those, we'll entertain a motion to approve.
I'll make a motion to approve the minutes.
I will second.
We have a motion and a second to approve the minutes of September 23rd, 2021. All those in favor?
Aye.
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 Any opposed? Motion carries. Thank you. And thank you, Lieutenant Moses. We heard you that time. 3A is...
Thank you.
You're welcome. 3A is new business with the Marquette Associates, and we will turn it over to you for your discussion, Pat. Good afternoon. Thanks for joining us.
Hey, good afternoon. Thank you, Dr. Bridget, and good afternoon, everyone. It's great to see you again and to speak with those of you online. So we have a fairly light agenda today. We'll start, if you would all just hop over in your book and turn behind Exhibit 1. For those of you listening online, this is going to be on page number 4 as far as recommendations for considerations today. So on page 4, you can see, it should be a fairly familiar table to you all by now, the fund allocations. These values, I'll just note, were as of the close of business last Thursday, since the materials were distributed on Friday. But I'd just like to bring a couple of quick things to your attention before we get to the specific recommendation. If you could focus it towards the top of the page, the third row over where you see the header there that says total assets, that is the total assets of the retirement fund as of the close of business last Thursday. So we're at just a shade over $136.2 million as of then. It's up about $1.5 million since we last met. A couple things driving that increase. Number one, we continue to receive some of the private market investment values as of the second quarter. But the more important driver was that equity markets have been fairly strong over the past month. So we saw some weakness in September where equities were down on the order of 4 to 5%. But in October so far, we've seen equities recoup all of those losses and then some. So that really drove the bulk of the gain in assets that we've seen over the past month or so. The next item I'd like to draw to your attention again is if you look at that bottom left table, that smaller table, again, just a couple of quick comments around asset allocation. So you can see towards the left of the table, we're listing the asset classes there in black. And then in the table itself, the black numbers are the current allocations, the targets in blue, and then the differences to the right of that in green or red, where green is indicative of an overweight and red, vice versa, an underweight. So if you look at the first three rows again, where we're looking at the equities, always important to point out that as we stand here today, they are within the permissible ranges per the current investment policy statement, which calls for plus or minus 9 percentage points within that asset class. And as you know, we've been sort of running that overweight for quite some time because that's the direction that we're heading. And then the corresponding underweight, you can see to the second to last line there is in the alternatives bucket. The last thing I wanted to point out before moving on to the specific recommendation, if you notice the cash line at the bottom of that table, we're about a percentage point above cash. So there are two cash accounts, one at Morgan Stanley to fulfill the capital calls for the private investments. The distributions from those investments also go back to Morgan Stanley, so that's sort of a self-funding mechanism for those investments. But we also have about $3 million in Wells Fargo at this time in cash. As you all, I'm sure, well know, we're going to have some upcoming cash needs, it's my understanding, with the drop payout starting next year. Based on some of the information that Ms. Patterson has provided, that's about $500,000 earlier in the year, and then a sizable one in the beginning of April of about $1.5 million. So we're carrying a lot of cash now, mainly due to the reason that we know we're going to need it in fairly short order, and that's really a conservative approach. When we know we're going to need the cash, we don't want to put ourselves in a position where we'll have to sell something at the wrong time to meet those needs. So we have plenty of it for that upcoming drop payment in the beginning of the year. But I suspect over the next few meetings, we may look for opportunities to maybe raise a little bit more cash in anticipation of that April 1st payment. Now, as far as the recommendation itself, if you look in the middle column on that table up top underneath rebalancing, towards the middle of the page, we are recommending basically a rebalancing out of the developed non-U.S. equity asset class into emerging markets. And a couple of quick comments for some additional color. So when you look at the developed non-U.S. equity composite there, you can see three managers where there is a largest allocation in the middle there to the Fidelity Index Fund that's just providing us broad exposure at a very low cost to those markets. It's complemented by the manager on top, Schroders, who is an active international value manager, and then the bottom manager, that PGIM, Jennison International Opportunities Fund, is the active international growth manager. But if you look at the respective allocations, which is right to the left of the rebalancing column, you can see that the active international growth manager has about a percentage point more than value at this time. And that's mainly due to the fact that over the past couple quarters, growth has done better than value in international markets. So this rebalancing is really accomplishing, or is meant to accomplish, two things. Number one, to bring that growth value split within developed markets back in line. And number two, use those proceeds to add a little bit of funds to emerging markets, which you can see right now has a 4.4% allocation, which is about 25% or so below the target of 6%. Now, emerging markets actually have underperformed fairly drastically this year, about 10 percentage points below non-U.S. equities and even further below U.S. markets. So this is more of a rebalancing of just quite simply a sell high, sort of buy low type of approach. So that emerging market allocation would still be about, 10% below its target or so, but we think adding money to that asset class is an opportune time right now since it has lagged so much during the current year. On page 5, that recommendation is explicitly stated. So you can see we do recommend the board approve that rebalancing as outlined, which again would be an increase of $1.25 million to the Emerging Markets Index Fund, being sourced again from the active international growth manager. And just to comment quickly on the fees, that index fund is obviously very, very cheap at just 8 basis points, where the active international growth manager is upwards of 80, 85 basis points. So this would lower the fees marginally for the fund as a whole. So with all that said, let me pause here. Happy to answer any questions or comments from the board at this time.
I want to be sure I understand your comments about the cash and the future draws.
Yes.
Do we, between now and, say, the end of next year, are we expecting only 2?
I would,
We have, thank you, we have, I want to say it's 9 participants that are in the DROP program that will be retiring, 2 in January and 7 in March.
so I think to your, if I understood the question, it's these 2, and I think there's another nominal one.
But not next year.
Well, I thought I did see one for June 1st, but I could be mistaken there as well.
Oh, okay. I don't think so.
Okay.
But anyway, I can double check that.
This would be the bulk of it. When I say nominal, I mean about $200,000. So it's either, as we stated here, around 2.1, or it could be maybe 2.25, but this is the vast majority of those cash requirements for the drop payouts.
And we have then those covered with cash on hand now?
Yes, because at Wells Fargo, we have about, $2.9 million, and the fund itself is cash flow positive.
Right.
So yes, we do have it covered. Then we may just want to generate a little bit more cash to slowly build it back up to target, as appropriate once the monies are
En route to our next big draw, which is over the horizon at
Yes,
this
sir.
point.
Yes.
Okay. How would we do that? By turning off reinvestments on something?
No, it would be our recommendation to do that via rebalancing. As I'm sure you well know, the reinvestment is a huge part of, a long-term return, particularly among equities, reinvesting, buying more shares over time. So I think we would, advise tackling that through a rebalancing, seeing what's overweight, and then maybe drawing that a little down to fund that cash position over time.
Well, doesn't that get us back into your thing about selling? We didn't want to sell?
Well, yes and no. So depending on what the allocations look at that time, if we are overweight equities, then equities have obviously generated pretty strong returns, so we'd be selling high. And if we do undergo some equity market weakness, then that's why we have that core fixed income in the portfolio, and we would look there. So it's something that we would address, when we get a little closer to it, depending on the asset allocation, how it stands then.
Okay. But for the time being, we don't have to worry about either of those possibilities because we can cover our near-term obligations.
Yes, sir.
Okay, that's all I wanted to know.
Any other questions from board members?
And I move we accept the recommendation to rebalance as shown.
We have a motion on the floor to accept the rebalancing. Is there a second?
I'll second.
Any discussion? Hearing none, all those in favor?
Aye. Aye.
Aye.
Any opposed? Motion carries. Thank you. And item B on our agenda for new business is investment policy statement review. Pat?
I'm sorry, Dr. Bridget, I think we have one more item in between that,
Oh, okay, sure.
as far as it relates to the Millennium distribution.
Okay, great. Let's jump back and get to the Millennium Share Class conversion. I guess that's under Exhibit 3 in our packet? Or-
Exhibit 2, so it's the next exhibit. So if you flip over Exhibit 2.
Oh, I see.
yes.
Thank you.
So this would be page number 7.
Thank you.
So there's a lot of verbiage on this page, and I'm going to also attempt to give the board some more background, and I apologize if I'm telling you all things that you already know through conversations with the previous advisor. But Millennium is one of the remaining hedge funds within the portfolio. There are three, two of them. One is Hatteras, and the other is a legacy Morgan Stanley hedge fund. Both of those are being liquidated over time. I think the aggregate value of them is only about $40,000, so it's a very immaterial allocation, and we're continuing to liquidate them and then get those proceeds back as appropriate. And Millennium, if you recall, was a manager that we recommended the board keep. They're a manager that's really a best in breed as far as within the hedge fund asset class. But if we look at this top few bullets, and then I'll back up and provide a little bit more background here. But since 2018, Millennium has been returning investor capital, or their investment funds, for those invested in a legacy share class. So it's our understanding the pension fund made their initial investment with Millennium back in 2014, when they had only one share class. In 2015, Millennium launched a new share class, and I'll talk more about that in just a second. But at the end of each year, what Millennium is doing is they're distributing funds from the legacy share class and then giving clients the opportunity either to receive it as cash or to convert it into the new share class. And then, as I note there, the only difference between the two are the liquidity terms, and I'll hit on that in just a second. But as a quick background, as why is Millennium doing this? So in 2008, they were down or experienced a negative return pretty much like everybody did in the global financial crisis. And their liquidity terms were pretty favorable relative to similar type of investments. So at that time, given they had pretty favorable liquidity, their investors, used them as a source of funds, right, to either rebalance back into equities as they got cheap, or to not have to sell equities when they were down by a bunch and used it for, liquidity needs, benefit payments, things of that nature. So at that time, there was a huge drawdown in the assets under management at Millennium. So in order to mitigate the possibility of that occurring in the future, that's when they launched this new share class. So this gets back to the liquidity terms. So previously, the legacy share class, an investor can essentially get all of their money back in about 2 years. The new share class, that's extended a little bit, probably about to 4 years, when you can get all your money back. Now, you can ask for it back on a quarterly basis, but they will not give it back to you all at once. And the reason behind that, number one, is, again, not to experience a huge drawdown in their assets under management, which would obviously impact the strength of the firm. But then importantly, as an investor, if a different investor puts in a huge redemption, then the cost of fulfilling that redemption is borne by everyone, right? Because everybody's invested in the same pool of assets. So that was really the impetus for them, trying to move investors from the legacy share class into the new one. And it's something that they are going to do and have been doing over the past few years. So you can see in that second main bullet point, after speaking with Millennium, given obviously we weren't working with you all at the time, last year the distribution was converted into the new share class. So that was confirmed by Millennium, and you can see below that the current split of the investment is 75% in the old one and 25% in the new one. This year's distribution amount will be about 35% of the old share class. So a third of the 75 would mean if the board chose to convert it into the new one, then we'd be about 50-50. And again, this is something that they're doing every year. Eventually, we'd be all in the new share class. But with all that said, we would recommend that the board, approve what took place last year, really for a couple of reasons. Number one, like we talked about, this is pretty much the best in breed manager in the hedge fund space, and given the newly approved asset allocation, the current allocation to Millennium is about 4%, which is in line with the target. So in order to keep that allocation consistent with where we're going over the long term, to us, it makes sense, at least from a recommendation perspective, to have the board approve the conversion as opposed to receiving it as a distribution. So with all that said, let me pause again for any questions or comments from the board.
So you use the word may request a redemption. Can they say no?
No, they will, so if we don't approve it and send back the document, the money will come. So in order to receive, or in order to have it be converted, there is a document to sign and submit to them to have it converted back. So the default option is actually to send the money back to the investor.
Okay, so it's not really a question, are we asking for the money to come? We're asking it to be reinvested into a different share class,
That is correct.
which is totally liquid?
So it is liquid in the sense that you can ask for your money back, but you can't get it back all at one time. So right now, if you wanted to fully redeem the allocation, it would take about 2 years. Going forward, it's extended to about 4 years for the reasons that I outlined earlier from a Millennium perspective and then also an existing investor perspective. I think it provides more protection for both parties.
And is there anything in the master document that says, no, we're all of y'all that want your money back on a redemption from the liquid side, you can't have it?
No, that's why they have it on a schedule.
Okay,
On a schedule as far as if basically you could say we want to fully redeem and then you will get paid out on that schedule, just like everybody else.
okay.
Any other questions from the board members?
We can change our vote on reinvest, non-reinvest at any point?
So this is a once a year, they're doing this on an annual basis. So it's my understanding based on what my conversation with Millennium that last year the board did the reinvestment and that's why you see this split. So this year they reached out and said if the board wants to reinvest, this document needs to be executed and then we'll be having the same conversation around this time next year.
So where my evil little brain is going, if we have that choice only once a year, should we be thinking now about flipping back to a cash payout?
I don't know that I understand the question. So let me try to answer it this way if I think I understand what you're getting at. So say next year this allocation is well above the target and they say it's time to distribute and convert, then we could say, okay, distribute it and we get the cash. But that's only once a year. But in the interim, we can ask for 5% of the investment back at any point throughout the year, but it's paid out on a quarterly basis.
Okay, so we can take a bite when we want to.
Oh, yes. Yes, I
Okay.
apologize.
Yeah.
But yes, that's exactly right.
So then, if we wanted to go cash distribution, we only have one opportunity per year to change our mind about that, correct?
That's correct.
Which leads me to ask, should we be changing our mind about that now, knowing that we're going to have some cash withdrawals coming up sort of near term?
Well, if we think about the amount of money that we're going to get back from this at about 30, so the amount invested in the old share class is about $3.3 million, or 3.25. So we would get back about $1 million
If we flipped back to a cash distribution.
for at this specific period, yes. Now that would leave us well south of the asset allocation target. So when we think about, raising money, and I talked a second ago about, raising it from places that are, doing the best so we don't have to sell low, we'll have the option to submit a redemption request each quarter for 5% of the investment, which would be roughly, $200,000.
A quarter, roughly.
Math correctly, yes, that's correct. So if we got back $1 million today, in theory, over the next year, we'd get back maybe $800,000 if we chose to ask for a partial redemption.
Okay, thank you.
You're welcome.
Thank you, that was a good discussion. Any other questions or comments from the board? I think we do have a proposed motion. It's motion number 2 under 3A for the Millennium distributions, if anyone's ready to make the motion.
I'll move to approve the converting upcoming Millennium distributions to the new share class as recommended by Marquette Associates.
We have a motion on the floor. Is there a second?
Sean Moses will second.
Thank you, Lieutenant Moses. We have a motion, yes, we have a motion and a second. Any discussion? All those in favor?
Aye.
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 Any opposed? Motion carries. Thank you. Okay, Pat, now I think we're on to 3B, the investment policy statement.
Yes, thank you, Dr. Bridget. So if you please flip behind the next exhibit, what you'll find inserted behind that first page there is a stapled copy of the investment policy statement itself. So what this document reflects the track changes that were discussed at the last meeting. So it shows all those respective changes throughout the document. It also reflects the new attachments around the prohibited investments and the glossary of terms. And then the other material change that we discussed per Lieutenant Moses's request was the addition of the manager watch list and termination section. So at this time, I just want to pause for a quick second. I'm happy to walk through everything as far as these changes, or I don't know if the board had a chance to review and just wants to make some questions or comments, but happy to do either as you see fit. I don't think it would take terribly long if I walk through the document.
So do any board members have any questions or comments on the document before we go kind of line by line? I'm not sure that's necessary in terms of, we did that last time, and then these corrections were made as part of our discussion.
That's correct.
As a result.
I had a question. So when we're talking infrastructure, does what the infrastructure is determine whether it's a debt or an equity? Let's say somebody wants us to help them build a toll road, a private toll road paralleling the Beltway, okay? Are we in that for equity reasons or for income reasons?
So let me answer this two ways. So an investment in infrastructure would be an equity stake. So much like, say, obviously a mutual fund, you have the equity ownership of those companies. In an infrastructure investment, you would be an equity owner of the pool of assets that invest in infrastructure directly. So it would be equity, not debt. However, to your second question, like we talked about, I think a little bit earlier this year, the composition of the infrastructure returns are predominantly cash flow and income driven. So if we look at a breakdown of the long-term return from infrastructure, which has been on the order of, say, 8 to 9%, about 2/3 to 70% of that is income, with the remainder of capital appreciation.
In a way, is it like owning a growth and income stock or a growth and income mutual fund, but with more income than you would normally expect?
To some degree, I think, with a growth and income mutual fund, depending on the makeup of the underlying constituents, the return composition, which would still be much more heavily weighted to capital appreciation. But to some degree, I mean, the other advantage for pension funds as we see them is that these are assets, if you use a private open-ended fund which has quarterly liquidity, is that the assets in the fund itself is not daily traded, right? So there's this smoothing effect, which we can have the discussion of, is it masking the volatility or not? But at the end of the day, if we can have a smooth return within the fund itself, then obviously we have less volatility of assets, more stable funded ratio, more stable contributions.
So when you and your firm came on board with us, I think you gave us kind of an eye-opening education on the pros and cons of private investment. Would we be facing those same problems of tying up money, waiting for a future call?
With respect to infrastructure?
Yes.
again, I'll have the consultant answer yes and no. So when you make an allocation to something like infrastructure, you make a commitment. So it's similar to the private market investment. So you might wait for that money to be called by maybe a year or something like that. But once that money is called and invested, you control the cash flows. So it's not like the private market. So you can redeem that pretty much right away. So unlike the private market investments where you make the commitment and the manager controls when they get the money and when they send it back to you, in this investment, they control when they ask for it, because they're not going to ask for it and have it sit in cash if they're not ready to invest it. But subsequent to that, you as the investor control the cash flows in a couple ways. Number one, you can have those dividends reinvested or returned to you, so that improves the liquidity profile a little bit. That's on a quarterly basis. Or again, you can ask for a redemption. Now there's somewhat of a grace period isn't the right word, but if you ask for a redemption, say today before the end of the quarter, then you'll get the money back, say on April 1st.
But is there a blackout period before you can even raise your hand to ask for a redemption?
There's no blackout period now, depending on the managers themselves. You can, I'm thinking of a couple of names in my head. One does not have any sort of blackout period. Another one does not have a blackout period, but there could be a little bit of a haircut if you ask for it back in the first 3 years, where you only get back 96 cents on the dollar. And again, that's just to protect the other shareholders, right? Because these managers and like everybody wants sticky investments, right? Sticky money, long-term partnerships with long-term investors. So there's a little bit of a divergence across the managers, but there's at least a couple where there is no lockup.
So when I hear the word infrastructure, I'm thinking about bridges and maybe canals and highways, and I'm thinking about expanding cable access, all that kind of stuff, all right? Why wouldn't we just buy a exchange-traded fund that deals with either the companies that are building that stuff, like a Caterpillar or a PACCAR or some rail car builder, as opposed to going down this path where we have these limitations, much like we went through with private debt, private equity?
So I think a couple things. Number one, you can use them as complementary pieces, right? So if we have a 4% target to infrastructure, we don't need to fund that whole private investment with a 4%. We can have another small sleeve within that to use as a liquidity bucket within the asset class itself. And then to answer your second question, and back up, you're spot on about the type of the investments. It's largely due to how those investments are valued relative to public securities that trade and have a lot of volatility and high correlation. So this is more of a diversification play. And again, for a pension fund, to the extent that we can tolerate a liquidity, those assets being smoothed over time should be helpful, again, from an actuarial perspective, a budgetary perspective.
Okay.
Am I answering your question?
To that question, I will say yes. If you ask me if I'm convinced we ought to go down that road, the answer is no.
Other questions or comments on the investment policy statement? Lieutenant Moses, anything from your perspective?
No, ma'am, and I appreciate the changes that were incorporated, reference the watch list. Looks good to me.
Great, thank you. And Lieutenant Safford, any comments?
No, Dr. Bridget, thank you.
Thank you. And Ms. Cudmore?
I think all the changes that have been made look great. Thank you.
Right, thank you. And so do you need a motion at this point if folks are satisfied? What's the...
Well, I think if I may, Dr. Bridget, what might be helpful, I didn't know how the discussion was going to go, obviously. So we meet in, I think, 3 weeks. So at that time, I can bring back a clean copy for the board for signatures then, and we probably might make the most sense just to make it effective 1/1/20 22, just so we have that clean calendar year break. So if the board is amenable to that, I think that might be the easiest path forward.
Okay, great. That's a satisfactory procedure for me. That's great. Thank you.
In doing that, would you check, let me see. Hang on, I gotta find it. Never can find it when you want to. There was a spot in here where I still think we need a plural verb.
Oh, I know what you're, no, I think I know what you're referring to, Mr.
I circled it,
Walters.
now I can't find it.
What we did was, and I don't want to turn this into a grammar discussion again, because I think I'll lose. But that was on page, here we go. So this is on page 6, under investment objectives, and then return objectives in the second bullet point. So what we did was we talked about the singular versus plural verb noun combination there, and so that from was added after the end there. So it's obviously total annualized net investment return, singular, from all the investments of the trust from each asset class. That from was added, so then the is modifying return, which is singular.
I still think it's R, but I will pass on that.
Great, thank you. And if any of the other board members, if you notice anything clerical, we'll pass that on to Catherine for any final, if we note anything, of course, not substantial. So, great, thank you very much. And lastly, for anything else for us today, you have some next steps on page 10, I think?
Yes, and again, we'll walk through this pretty quickly. This will be, will look pretty familiar to the board. So at the next meeting again, which I believe is 3 weeks from today, we'll have that Q3 investment performance report. Any recommendations as typical, and then obviously it says policy review update. We will bring that clean document for board signatures at that time. And then the only other thing that I wanted to hit on below is the custody RFP updates, just for the board's knowledge. We've been making a lot of progress there. Ms. Pratt's really leading the way with the help of Brandon from procurement. That RFP has been posted. I did receive confirmation from 4 custodial banks that they will be participating, including the 3 that we discussed earlier this year, including the incumbent, and another larger bank that's a major player in institutional custody and trustee services in the Mid-Atlantic area. So we're going to have at least 4 solid responses. I imagine we will get some others. But as far as the timeline, the proposals themselves are due in early November, I believe. They will be distributed to the evaluation committee before Thanksgiving, along with some scoring matrices that, again, myself and Ms. Pratson will put together. Those evaluations are due in mid-December. And then from there, we will work to set up any short list for a presentation in early January, with the hope that the award follows soon thereafter, and then hopefully a transition period probably in the second quarter, given again that the Wells Fargo principal transition is occurring at President's Day weekend, which, is, you all well know, is kind of in the mid to late February. So we're moving things ahead, excited about the process, and I think we're going to have some strong proposals. So I just wanted to bring that to the board's attention, and that is all I have for today.
Thank you very much. Anything else for Pat this afternoon for the board members? Great. Thank you very much. We appreciate it. We'll see you in 3 weeks.
Thank you.
Next on our agenda is 4 old business. A is Bolton presentation, a follow-up item. Ms. Pratson?
Thank you, Dr. Bridget. And this is informational, and I believe I sent an email to everybody already, but wanted to follow up on a couple of the pending items that were raised last month when Bolton went through that extensive review of how benefit statements are calculated. And you may recall that the military service pre-2008 and post-2008 is treated differently. And we wanted to confirm that the online portal that the participants have available to them them, that the math was included in that portal, so benefit estimates are taking that into consideration. And Bolton confirmed that they are taking into the calculations the different military service in that break. And then separately, there was a discussion about sick leave. And when the portal was originally created, there was a cap of 4,000 hours of sick leave. And truly, the cap was added with the idea that to prevent somebody from putting in an artificially high number and getting an artificially high benefit. And it was to just protect the user and the statement from that. It turns out that we have some participants with more than 4,000 hours of sick leave. In response to that, Bolton removed the cap. And then they have asked us if we want to impose or add a cap. And it's really up to the board to decide. I've had a number of people email back saying that the proposed 6,000-hour cap makes sense. So with the board's consent, we will ask Bolton to do that.
So there is a motion on the table to approve that in a formal way, just FYI, I'm sorry.
Can any employee earn more than 6,000?
I don't know. I didn't know that you could earn more than 4. There's an unlimited amount, right? Sick leave is not capped.
So it's only capped in
Yeah,
this document.
I would say that 6,000 is highly unlikely, and I think that's a safe number to go by, that it would not be exceeded.
Oh, thank you. But truly, the cap is only in this portal, so it's just for the purpose of getting a benefit estimate.
It is totally disconnected from what's going on the HR side and...
Correct, and
Okay.
totally disconnected from when an actual benefit statement is calculated.
And you think 6 gives us enough wiggle room so that if there is a person who earns more, we're not back here redoing it again?
So I think, was that Lieutenant Safford that just spoke? I think the Sheriff's Office feels that
Yes.
6,000 is a very reasonable number.
Okay.
Yes, that is me.
So,
So we have a motion.
Yes, there's a motion. If someone would like to make the motion for the cap.
I'll move to adopt the 6,000-hour proposal.
Is there a second?
I'll second.
This is Clay Safford, I'll second it.
Thank you. Is there any discussion? Hearing none, all those in favor?
Aye.
Any
Aye.
Aye.
Any opposed? Motion carries. Thank you very much. Number 5 is committee reports with the administrator's report, and that goes to you, Sheila.
Okay, we received one invoice from Bolton, and it had 2 different, they addressed the calculation request that Catherine had requested from them as far as answering questions on the portal and stuff. And then the second part of the invoice was 2 retiree calculations for a total of $1,360.
Great, thank you. Any questions on the administrator's report? Hearing none, do we have a motion to approve?
I'll move to approve the report in the amount of $1,360.
Is there a second?
I'll second.
We have a motion on the floor and a second to approve the administrator's report. All in favor?
Aye.
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 Any opposed? Motion carries. Thank you very much. Next on our agenda is public comments. Do we have any public comments for today? Hearing none, we need a motion to adjourn.
So moved.
We have a motion to adjourn. Is there a second?
I'll second.
We have a motion and a second to adjourn. All those in favor?
Aye.
Any opposed? Motion carries. Thank you all very much. Appreciate it.
Lieutenant Moses,
Good
before you
afternoon.
go, can I ask you, did you receive that book I dropped off?
I did, Mr. Walters. It's sitting on the corner of my desk, and I'm preparing for my tax exam.
That
Great.
wasn't why I dropped it off, but I hope it answers the question you had.
It does, and I'll return.
Great. Thank you very much.
All right, thank
Motion's
you.
adjourned. Meeting's adjourned.